One, two, one, two. Right. Hello, everybody. It's currently about 2 o'clock, which is 30 minutes after New York Open. I was kind of avoiding trading today, but I was just like, you know what? Let's go. I don't really want to enter a trade unless it's perfect. So the dollar has been moving quite a lot. We thought it was short-term bullish. Turns out it was long-term bullish. We also had a lot of news around kind of afternoon time, and it was all bullish for GBP. And of course, if you look at DXY, you can see that we've created this high over here. We're taking out all this liquidity. So I would expect that price will want to displace downwards and have a market to shift and break to the downside. I did predict it to come up to this area to then go down. So I kept that there to show you, but that has failed and price has simply continued up despite being in the premium. When you also look at the weekly time frame, what do you notice? Well, that range we drew, you can see the price has swept the highs. So there's a lot of liquidity that has been gotten by DXY from it just breaking this high over here. Also, my phone is dead, which is a problem. Because if I do find a trade, I won't be able to enter. Okay, let's find a trade first. Then worry about that in a bit. Okay. So this just looks like it wants to continue going down. We came up into this fair value gap on the 4-hour time frame. We've had the market short to shift to the downside. We've swept the highs of London. We've come back into the range of Asia. Price may be targeting the high of Asia before it wants to come down. And from the open as well, we've done into this fair value gap, pushed up. I'd argue this is the so it's broken this 1 hour order block. Then you can also see on the 15-minute time frame, it's this range right here. So I think if it closes above this order block, we'll reach into towards the Asia session high. I'm with you. This has to be like 35. Oh my gosh, dude. Oh my! Next Tuesday, we're cooked. What? Oh, GG. Anyway, we're taking out the London low, come back into the range with a displacement. However, I think it's the bearish if I had to guess. Creates another lower low. I think this could be bearish. I don't think I'll enter this, but I'm just kind of scanning. Where's your USD? Oh, there it is. So give me a second.
significant or obvious swing high and swing low. Swing high is this. The candles are up or down closes. You're just looking for a swing high because above that's going to be buy side liquidity. Swing low prior to 8:30. That's a candle that has a higher low to the left and a higher low to the right of it. It's 3 candles. Again, it does not matter what the close of the candles are. It has absolutely no bearing on what I'm showing you here because the swing points are where liquidity is going to be placed. So once you have these levels on your chart on a 15-minute time frame, then you can drop down into your first lower time frame for entry. That's your 5-minute chart. So let's do that now. All these things will be transposed right to the 5-minute chart. All right, so now we have this old high back here. Look at this price right there. Okay, that's going to be the high price. On that particular candle right there, it's 45.14 and a half. This candle trades to 45.14 and a half. Exactly the same high. But look closer. We have relative equal high, but we have it in multiple short-term highs that keep going higher. If there's 3 highs that go up like that, that's a classic 3 drives pattern. And that means it's a swing high, a higher swing high, and a higher swing high. So it's 3 times the market kept pressing up. I like to see this pattern forming when there's an old high back here, okay? On any time frame, it's universal. But if you ever start seeing these 3 drives up into an old high, you don't have to see that third high take out the old high because what it's doing is it's already pressing into running out liquidity. Every time it creates a swing high and it starts to go down, bears are trying to sell that and they're putting buy stops right above the previous high and they keep getting taken. So it's already building in liquidity, and informed investors or quote unquote smart money will be already establishing short positions. Then the market breaks. In one of the previous videos, I've talked about the pattern or the setup, and I suggested not using a particular swing low that looks like it's been violated. I want you to think about this idea that I teach, which is displacement. That's what you're looking for in price. When price goes above an old high and it trades down below it, you want to see an obvious displacement. You don't want to see it just do like, oh, well, you know, a little lethargic run here. That's not enough. This is like that elephant falling into that children's swimming pool. It's no doubt about it. It really had a displacement. When that occurs, then you go in, you start looking for the fair value gap, the low, the high, and if it trades back up into that, then you can look for a short. So now we have this previous high, previous low, very weak anemic move lower. Then you have another run higher here, and then you had this wick or tail come down, and it quickly snaps back. Does that create a fair value gap in that? No, it's not there yet. Then it goes higher here, doesn't go above, it matches that high, but then now this high, watch, does it go below that? Yes, a little bit here, but it's a little anemic still. But then look what we have here. It trades up and then smashes down. Then the next candle here closes. What do we have? There's your fair value gap. That's your short, and you could reach for the liquidity resting below that low that you would be identifying prior to 8:30. So sell side liquidity matching up with your short. You sell, you want to buy it back to cover that short. Well, here's waiting sellers right down here in the form of sell stops. Bam, hits it. Putting aside that you may not have seen this as a long entry, okay? Maybe you didn't see this as a potential continuation of bullishness, but look at these highs here. What's resting above that now? Buy stops, buy side liquidity. And then what do we have here right before lunch hour? It goes slightly above it and then trades down. And then we're in that time of the day, you don't trade it. New York lunch hour, noon to 1, don't trade it, okay? Do not trade it. It can do a lot of weird things in that hour or simply do nothing and go sideways. But either way, you don't want to be a participant in that because it's not usually a clean time of day for price action. So now here we have the high of the day and all the liquidity resting above here that would not have been tagged by this. In other words, stops that are resting a little bit above that. Because there's a lot of people trying to sell short. They want to see this thing go lower. But we created a very important low last week, and the market has already tanked a lot. So it's pulling back up in the run that it created going lower on a daily chart. So all these buy-side liquidity pools here are going to be a reason for the market to want to reach up to that. Because you don't have to be a participant down here as a buyer. You just need to know on the other side of lunch at 1 o'clock, start watching and see, is there an indication that this thing wants to go higher? And as you can see, all the buy side liquidity here was ran aggressively here, but then the market trades right into the close, aggressively bullish, small little retracement here, small little retracement here, and then immediate run right into the close. Now, obviously, market trades a little bit beyond that. But this time of day, expect whatever algorithms that you would expect to be driving price and price runs to pretty much cap the majority of the volume that's going to be in that day. So what I want you to think about is how the day's designed to have a morning move, a lunch hour where you don't want to be trading, and then the afternoon move. Go back through your charts, and you can go back as far as you want. The more you do this, the better you'll get. But I want you to think about creating your charts like this and then describing what the morning trend was. Was it a bullish move? Was it a bearish move? Was it consolidation? If it was consolidation, prior to that part of the day, in other words, the previous day or the previous days, was it bullish or bearish then? Because if it was bullish, this is probably setting up another continuation higher, especially if you start seeing these relative equal highs forming, where it paints the idea that this is retail resistance. So traders are going to think that this is going to go lower, and it starts to build up a lot more interest in the form of buy-side liquidity or buying interest at a high price. Even though that those traders may be framing the context of their trades as a short entry, trying to make money going lower, their protective stop, if they choose to use one, is going to be in the form of a buy stop. And this is where it's going to be at. So the market's going to want to gravitate towards that, especially if you start seeing swing lows that are forming. Every candle has a higher low to the left and higher low to the right. If they start building up, and every time they create a new one, it's going higher, that's a underpinning of the marketplace that's showing accumulation. It wants to go up because it wants to clean out all this here. Plus, we've been going up for a few days on the daily chart. Plus, the sentiment is everybody thinks it's been going down, so they all want to sell short because they want to see a stock market crash. But what they are failing to realize is we've already went down below an old low on the daily chart. So now we're running back the other direction, and anyone that's trying to sell short, unless it's a real quick intraday scalp, they're having their clocks cleaned. So in the afternoon, there's a trend, and one of the built-in characteristics of the afternoon is there's mechanisms that are built in that help this market really accelerate into the close. And if you study the price action in your lower time frame charts, you'll see that there's a repeating phenomenon that's typically around 20 minutes to 4 and 10 minutes to 4 and 4 o'clock. And it's all based on market on close orders. That's really what it is, okay? And the algorithms will start spitting out really, really aggressive pricing and forcing traders to either cover or get out of their trades. And usually if it's going up, it really just ramps up and accelerates in that direction. So if you know what your daily bias is, and if you know what you're looking for in terms of range expansion on the daily chart, now what do I mean by that? The daily candle, do you expect it to trade higher or lower? You're not trying to predict, every single daily candle's close, but you're trying to determine, do you think that the daily candle you're looking at forming today, or what would be forming tomorrow, is it more likely to be expanding higher or lower? If it's expanding higher in your analysis, that means you want to try to trade with the expectation to find a trade in the afternoon based on the logic that was used in the morning. And everything I'm showing you here is the same thing every day, every single day, same thing. So back to the homework assignment. I want you to think about outlining what the session was in the morning, and then what did the session do in the afternoon. Sometimes what you'll see is it'll be bullish in the morning and then reverse in the afternoon, or it'll be bullish in the morning and continuation higher in the afternoon, and you'll get like a measured move. What's a measured move? Whatever the morning move was, it'll duplicate that twice. So if it moves up 200 points in the morning, the afternoon could see another 200 points in addition to that and have a 400 point range. Or we could have consolidation in the morning session, and then it trends in the afternoon higher or lower. If this day was bullish for you, say you had the benefit of knowing that through analysis you felt that this was going to go higher, this swing low here, first swing low of any importance after 130. This is really important. 130, I'm looking for swing highs and swing lows for the afternoon session. That's what I'm looking for. It's the same context that I use for the morning session. I'm looking for swing highs and swing lows prior to 8:30. I'm looking for the first one, okay? I'm not needing to go back days and days and days. I'm just looking for the first one. At 130, that's usually when I'm wanting to start trading the afternoon. That's the earliest. But I'm preferably looking for a swing high and swing low to form at 130. Why 130? Because there's an algorithm macro that starts running at 130 that creates movement at 1:30 in the New York session, okay, in equity market. So when that occurs, all we're looking for, or what I'm looking for, is a swing high and a swing low. And then that same basis of looking for a stop hunt in the morning, like we described here, I'm looking for the same thing here. That's it, same thing. So now think about this. I'm thinking that these stops are in jeopardy because it's too clean. The level's too clean. Straight line edges in the market, they don't tend to stay like that. There's going to be a disruption. The market's been going higher, hasn't it? Yes. There's this pent up aggression that this market wants to go higher, but it's seeing short-term resistance here, it tried it a little bit here, and then retraced inside the lunch hour. The algorithm reserved the price run until later in the day. Now watch what happens. This swing low here gets violated right there. That small little stop hunt is all that's necessary. That will start what is called a buy program. A buy program is when the algorithms go into the process of spooling. Spooling is where it just continuously keeps offering higher prices. That's your signature. That's how you know that this is being completely manipulated. So if it's being manipulated, doesn't it stand profitable for you to know what it's likely to do? Not if you're going to know it all the time. You're not going to know. I don't know it all the time. But these things tend to repeat. And if they repeat a majority of the time, not every day, but the majority of the time, it's probably going to pan out. and then you can start doing long entries and then hold for the close. So inside this area, the market creates a swing low, runs through this low, stop hunt. So the stops below here are what? Sell stop. Buy those sell stops. It's the same thing took place over here. Buy the sell stops that are resting below here and expect this level to be taken in. Consolidation through lunch after 1:30 in the afternoon, wait for a swing low to be violated, and then rally. What if you don't get a swing low that trades below it? What do you look for? Well, you look for a move higher that's sudden, displacement higher, then look for a fair value gap. If it trades back down to the fair value gap, you buy that. There's your two patterns. That's it. It's the only two patterns you need. All right, folks, welcome back. This lesson is going to be on Forex and how we can apply this model to the FX market. All right, so if we're looking at the euro dollar, and I'll let you know that's what this is. This is a daily chart for euro. I want you to take a look at how price moved above these relative equal highs right here. Now, once it did that, this took the buy side or buy stops out of the marketplace here. Then it started going lower. What would it likely be reaching for next? Well, it took buy side out here. What do you think's resting below here? Sell stops or sell side liquidity. Now, just to the left, notice these two little devils here. Relative equal lows. And with this one and this one, we have two areas of sell side liquidity. Notice this candle here, which happens to be Monday's trading or yesterday's trading. This low did not take out that low yet. Notice that? So we have unfinished business below here and potentially below here. So if this is a daily chart, what is the bias? The very next candle, what's the bias going to be? Bearish. We're anticipating bearishness going in. So let's take that and flesh that out a little bit more. So here is your chart that will be annotated, and you'd have this level on your chart while you're learning. It's important to have these types of things on your chart. And what I mean by that? Well, having these relative equal highs highlighted, your buy stops would be resting above here, and the market will go just above that a little bit, and then once those buy stops are taken, for anyone that's short, they're getting knocked out in a loss, and that flood of orders to be buying at the market is counterparty to individuals that want to sell short. So smart money is selling short up here, with the expectation it's going to go below this low here, and potentially below that low down here. So today's trading, we had the open, it rallies up a little bit, then careens through the short-term low here and below the relative equal lows here. Now, what level on the downside after this day closed, if we're looking for lower prices, what could we expect it to draw to? Obviously below here and below here, but what price level? 109 big figure. So the big figure numbers, or the zero levels, they're very influential because there's lots of liquidity that is used around those levels. A lot of commerce, a lot of business transactions that come in just for the sake of simplicity. 0 level, the 20 levels, the 50 levels, and the 80 levels. So I dubbed them institutional price levels. All right, so we're going to drop down to an hourly chart. Before we get into that, I'm going to revisit the swing trading idea that I call highest up close or opening in this retracement up, and the lowest open or close is here. So I left the highlighted candles so you can match that up on yours. And then we have this old low. So below this old low, if it goes below that, how many pips can it go below that? Well, we have the big figure 109, right? Remember the previous chart here? Watch. Over here, that's essentially the 1.09 big figure. So do we have any levels in here on the fib that correspond to that? Well, we have 1.0919, that's possible. Then we have 1.09101, that's another level that's possible. Then we have 1.09011, essentially almost the big figure, right? So we have a standard deviation from this swing to here. If this is broken, these are only true if this low is broken, okay? So this is a Fulcrum point, and this is a Fulcrum point. So how do we know which level we're going to aim for? Well, we have those relative equal lows at the 109 big figure level, and then we have our fib calling for these levels down here. And the lowest one, without going through 1.09, is this one here. All right, on the hourly chart with our buy side liquidity pool level here, the market trades up into that area, absorbing all of that liquidity, then breaking down, takes out short-term low here, and here, and here, retraces up in, breaks lower. Then we go into today's trading, the fifth. Prior to the day starting, we know that it's likely to draw below here, and then down to that 109 big figure. Have a lot of conversions around that 109 big figure. At the beginning of the day at midnight, New York local time, that's going to be right in here. If we see the market rally up, which is what we want to see, we want to see a protraction in the marketplace where it starts to go against the expected direction of the move intraday. So if we're bearish and we're looking for that 109 level to be traded to and attack the liquidity below here, preferably we want to see it rally first. That's the Judas swing. Okay, that market protraction is what we're looking for manipulation, part of my concept power 3. Once the day begins at midnight, we're anticipating a move up. What's it going to be trading up into? This imbalance, I think. Okay, so once it does that, it kind of like forms the daily high, and then the rest of the day you're going to be looking for distribution throughout the day, looking for lower prices. So inside that little shaded area, we're going to use that going forward. So let's drop down to a lower time frame. 15-minute time frame. Here is that imbalance. It doesn't look that clean on a 15-minute time frame, but the hourly is what we're framing it on. So the market trades up into that. Here is the midnight New York local time candle on the 15-minute time frame chart. Opening price is here. Extend it out throughout the day. That is your midnight New York candle opening price. Preferably, if we're selling short, we want to see price trade above this opening price. This is where smart money is accumulating short positions. See that? So the algorithm goes higher, once more higher, and again right here, and then begins its descent into the daily range low. Now, what's occurring here, this is not buying and selling pressure. The algorithm is offering constantly price above this opening price. Now, every single time it rallies up, just because it does that doesn't necessarily mean that's a time for you to get in. But when you couple that with time of day and price, it becomes a lot better. Notice we have an imbalance in here. So the fair value gap there, and price runs up during the New York open kill zone. Okay, so I dubbed this specific time of day between 7 o'clock in the morning New York time to 10 o'clock in the morning. This is specific to Forex, okay? These times are specific to FX pairs. So if we're looking at this imbalance here, the market runs up and it overshoots the imbalance a little bit, but what's it really go to? The last close candle, which is a bearish order block. How do we know it's a bearish order block? Because we have the imbalance here, and it's trading back up into after a nice move lower, so it's displacement, fair value gap, last close candle, touches it, there's your bearish order block. Dropping down into a 5-minute chart, everything being as it was on the 15th, that's that order block here, just being shown on the 5-minute chart. But I'm adding now the annotation of the New York open kill zone. 7 o'clock in the morning begins here at the end of that line segment, and 10 o'clock is here. So everything underneath this end of the trend line here and below this part of it, this all is during the New York open kill zone. So you're hunting your setup for Forex pairs within that little block of time. So during this time, you're hunting your setup. What price are you looking for? Preferably at or just above the opening price at midnight. Now, if you are a New York session trader, you want to refer to the opening price at midnight, but then you want to recalibrate at 8:30, and we'll look at that in a moment. But for now, just notice, looking at this particular day on the economic calendar, we had a high impact news driver at 10 o'clock in the morning with the ISM services PMI number. Now, so that little bracket of time right there on a 5-minute chart, you're hunting your setup. What is the thresholds that make it high probability? Well, if you're going short or looking to go short, you want to be above the midnight opening price. That's here, extending out in time. But now, once we hit this order block here, that was during the early stages of the New York Open, right around the 7 o'clock hour. The market drops and then retraces back into that news driver here at 10. So what's happening here is, look closely at this low. It went below this low here, and then it rallied back up once more above the opening price at midnight. Does it take out this high? No. Why doesn't it take out this high? Because it has an imbalance here. That imbalance tells you that this is an intermediate term high. If we're bearish, it shouldn't take this high out. Now, again, a imbalance or fair value gap associated with a swing high or swing low. In this case, this is an intermediate term high. Not because it just simply has an imbalance, but because the narrative is we're expecting lower prices, and it went above the opening price at midnight, and the imbalance there, when it retraces back up into this fake run ahead of the news driver at 10 o'clock, the news, if you will. This movement here is only running right back up into the bearish order block. That's a closed candle, the body. I don't like to use these long tails and wicks. I'll refer to them, but I like to prefer to annotate if I'm going to show it in my examples, or look to price returning back to the body of the candle. Okay. So this return into that order block sets the stage for another move lower. You get a swing high, lower high to the right of this candle, and a lower high to the left of it here. So we have 3 candles making a swing high. So we start looking for displacement and movement lower. But looking closer, after we had that shift in market structure here on the 5-minute chart, it retraces back up, fair value gap, bearish order block, and news. This is the wild card. Okay, when you have high impact news drivers, this is going to many times scare you out of the trade or stop you out. In other words, if you went short back here and you start trading your stop loss, this is what that's designed to do, take you out. But inside this shaded area, I want to show you how this model is applicable here in FX. So here's the 4-minute chart, and we're looking for any fair value gap. Do you see it? This candle's low, this candle's high, there's your fair value gap. Isn't it interesting how this goes right up in there, closes that in, then and only then the market starts to aggressively going below the short-term low here and reaching into our objective down here at that 109 big figure. Now, it doesn't quite get to 1.09 even, but it does get to our Fibonacci extension for the standard deviation. It does get down to the old relative equal lows on the daily chart, which is what that blue line is. Look at the bodies respecting that low. Not much movement below it. Right up in there, closes that in.